So now we're going to discuss who uses futures and forwards contracts and how. You either expect a price of something to go up or to go down. And with the futures, you get to lock in the price. The question of which position you enter into depends on your reason behind entering into that position and also what you expect to happen. So, we usually take the position of hedgers, and the market was created for hedgers. So hedgers seek to protect against any price movements. So you would go long or lock in the price now if you're worried about having to buy something in the future and worried about the price of it being, higher in the future, the price of it going up now. You would take a short hedge if you need to sell something in the future and you're worried about the price falling in the future so that you would get less for your money. But speculators will follow the exact same logic. They'll take a short position if they believe the price will fall and a long position if they believe the price will rise. The only real difference between speculators and hedgers is why they're doing it. Speculators don't have an underlying reason. They just are trying to profit based on price movements, versus hedgers are usually trying to protect a position. So if you have to buy something in the future, you can protect against an increase with a long hedge. If you have to sell something in the future, you can protect against a price decrease with a short hedge. So how do these trades take place? Well, we talked before about the fact that forwards contracts are negotiated versus futures contracts work through a clearinghouse. So that's really what you're seeing in this A versus B, but you're seeing the flow of the funds here. Basic trading mechanics, the exchange acts as a clearinghouse and counterparty to both sides of the trade. The net position of the clearinghouse is 0. It has both a long and a short position in there so that it ends up having no position at all. The open interest is the number of contracts that you have outstanding, but only 1 to 3% of contracts actually result in a delivery. Most sides just take an offsetting position to close out their position, meaning if you had a long contract, you would then short that same contract and vice versa to close out your position. Now, what's kind of interesting is that no one actually buys or sells a contract. You just agree to buy or sell the underlying commodity at a pre-specified price. The wording is just basically there for convenience. When we talk about open interest and counting the number of open contracts, a long and short on the same commodity are not counted separately in terms of its open interest. Okay, so let's discuss some trading mechanics and see how some trading works. So in order for trading to flow and protect the trading house, remember their net position is 0, our futures contracts are marked to market daily. And there are 3 factors that go into marking to market daily: the initial margin, the maintenance margin, and if you experience something called a margin call. An initial margin is how much you have to put up in order to enter into a contract. So there is leverage in these examples. You do not have to put up the full purchase price. You only have to put up a small percentage of that. So that small percentage is known as the initial margin. The maintenance margin is how much you have to keep in your account at any given time. If the value of your account falls below the maintenance margin, then you experience what's called a margin call, and you have to put in money till you get up to that initial margin again. So we should click here, and this should lead us to information about gold margins. So we can see on here the maintenance margin on gold, right? So now we are looking at orange juice futures, because why not? Okay, so we can see that the current price of this orange juice future is $109.75. And we can see that the contract is on 15,000 pounds of orange juice solids, I guess. I don't know. Liquids, who knows? The tick size, that's the amount, the smallest amount by which the price can change. So the smallest price change is $7.50 per contract, or 5 cents per pound. So the way they got that $7.50 was by multiplying the 5-cent change per pound by the 15,000 pounds on which you are dealing with. Okay, so how does this work? Well, you put up only a small amount in order to take a position in this. That small amount that you put up is called the margin. The margins are always listed like this, margin/maintenance. So what this shows is the initial margin and then the maintenance margin. You put up $1,386, and you have to maintain $1,260 in your account. If you fall below $1,260, you have to put money back up so that you come up to $1,386. Okay, so if we expected this price to go up in the future, if you expect a huge demand for orange juice and therefore an increase in price, you would take a long position, meaning that you're betting that this price will go up. The minimum amount that it can go up is $7.50 per contract. In order to buy a contract, you have to put up $1,386. It can go down, if you're betting it goes down, then you would take a short position in this contract. Now, in order to see how many positions are available, we can look at the open interest information, which should be listed on here. Here's the long and the short in general to give us some information. We can also see highs and lows, what's been happening over time in this contract. No, this one is not showing us open interest, just highs and lows. Okay, you can find that information on Bloomberg. All right, so now we should have a general idea of how we can figure out the value of our position as a result of buying a futures contract.